Till today, everybody was doing the covered call like this. There was no better alternative available. Till today. Hi everybody, welcome to the video. Smarter covered call. Stop wasting your premium. You're gonna learn how to make your covered call even better. Disclaimer, the strategy explained is only for educational purpose. Stock market option trading contains risk to capital. Now let's understand everything there is to learn about covered call and making it better. What retail rarely discovers. Doing covered call from many years. But do you know this? Let me explain you better than anybody ever can. If you're watching this video from any part of the world, this is the textbook definition of a covered call. We long the future in the current series, which you can see over here, 28th of August, which is the monthly series, and we are shorting the call, which is around at the money. When you do something like this is how the payoff looks of a covered call. Margin, it takes approximately 2,45,000 rupees to make it. Now in the covered call, why do you make covered call? Only for one reason, that you expect stock to shoot up. If the stock go up, obviously you're bullish on the stock. That's the reason why you are long in the future. If things go right as per your analysis, you expect to make around 15.6, right? This is your standard covered call. Wherein the negative part is that if market go completely opposite of your view and instead of going up, market starts to go down, then you are looking at really big loss. Now I know very well why do you do covered call, because if market go against you, then what you're gonna do is that you're gonna roll your calls, the standard practice, the standard adjustments, which we do not do. In fact, I've made a couple of videos on covered call, which is even better than how most people trades. Now I want to ask you, is it possible that if your view is right, the reward which you get is 15.6, your reward increases? But at the same time, if market go completely opposite of your view, as you can see here, such a valley of red, these losses remain capped with the same margin. Is it possible to make it a better alternative of covered call? Gear up, I'm gonna tell you exactly that will make your covered call even better. So we're gonna start this by longing the future as it is, which you've been doing, but instead of one, we are longing to future. Step one. Step two, in covered call, what you do is that you sell a call. Here, what we're doing is, this is at the money 24,700. We look to long 2 at the money puts. We long the future, but here we hedge it. We do not leave it naked. That's not a smart thing to do. You know it. And after that, what do? We go slightly out of the money, and now we sell 2 calls. When we do something like this, we'll see how this turns out to be. Number one, your margin obviously gets reduced. That's the reason why you are doing it with 2 lots. And when you do something like this is how it emerged. Now compare this with your standard normal covered call, and then I'm also going to tell you VIP points how to make it even better. This is your standard covered call, in which if market go up, you expect to get a reward of 15.6, normal copybook strategy. You are paying 2,45,000, but your downside is completely open. When you do this strategy, which I told you, in this, if market go in your favor, but the best part is, if market starts to go down very fast, and even if market go to whatever extent, you can see that your negative side remain capped. Versus here, if market crashes, what you see is a real trouble if market starts to go down. But here, you can see a really big difference. Now here, in terms of margin, of course, Opstra is not showing the correct margin. So I'm gonna put a screenshot here, which you can compare and you can have a look at it. In this one, longing one set, this is 2 set, one set cost approximately 90,000. Here we have long 2 sets, that means approximately the margin deployed is roughly 1,80,000. So you are deploying lesser margin compared to this. Here it's 245. Here you're deploying 180, because obviously the margin calculation of Opstra is incorrect. You are paying lesser margin. Your reward is not getting compromised. If market shoot up, you expect to get better. Your downside be protected. Now I have a question for you. Why covered call everybody seems to do? What is the benefit which covered call has? I leave it up to your judgment. अपने फायदे की बात इशारे में ही समझ में आती है और एक ट्रेडर को अपना फायदा, अपना इंप्रूवमेंट दूर से ही दिखना चाहिए. Now I want to add a few more points here. We're going to make it even better. VIP points. Point number 1, covered call adjustments versus adjusting this. Covered call, the simple adjustment. I know how you adjust, most of you. What do you do if market starts to go down? You bring your call down. First of all, there are better ways to adjust. I've made a video. Learn from it. Instantly, you will find some amount of confidence for sure. But here, in this particular strategy, I want to ask you one thing. Suppose that you do a covered call in any stock and that stock go down by 10%. Your covered call is in massive trouble. Doesn't matter how much rolling you can do, that loss will be always going to be bigger. Here, suppose if you do something like this and if your stock go down by 5%, 10%, right? Now, even if you don't do any adjustment, next series when you come, can't we make the same strategy the next month? The stock is expected to give some kind of a bounce after a 10% fall. So if it bounces, the covered call will need a much bigger bounce to cover your losses. In this strategy, when you do it next month and you take a hit this month, when you again recreate it, again your window is open. If stock go up, then instantly the green zone is there for you. I want to repeat. Think about the worst situation, because in best situation, this strategy alternative I told you is winning, as you can see very clearly. In the worst situation, if market is going down, covered call will ask you for a lot of adjustments. But here, the losses are capped. Suppose you do not do any adjustment, you again recreate it when market go down, a little snap back up, and then you immediately expect it to come in green zone. You can definitely consider this. There is one negative point of this, although in a lot of areas this is winning in terms of margin, everything. But one negative point is, in covered call, your break even is lower. In this, your break even is higher. But you can always tweak your strikes and make it as favorable as you can. I've just given you a basic structure. If you play around with the strike, you can make it this negative point also into positive. Now I have a question for you. Why this method remain undiscovered? There is a big reason for it. Like I said, on this channel, we talk about only advanced thing. We do not talk about basic stuff. And obviously, you do not underestimate this channel, because you do not underestimate your power to learn and your power to improve in the game of trading. Anything in the world can be improved, can be better. After learning, things are a lot different. You just realized, you just witnessed it. That's why I say trial and error in trading is equal to costly mistake. If you want to elevate your trading game, you want to go deeper, check the pinned comment or description for resources. Thanks for watching. I wish you all the best. Bye-bye.